VICI Properties is a REIT that specializes in owning and leasing gaming, hospitality, and entertainment properties such as casinos and hotels. The company was founded as a joint venture by MGM Grand Las Vegas and Mandalay Bay. They generate rental income by leasing these properties to operators in the industry. Just like the entire REIT sector, VICI has been down this year, with the stock seeing a decrease of over 8% year to date. Looking at the longer time frame, we can see that the company is up over 37% since its IPO. However, this is without dividends. Dividends are a big part of the reason why investors invest in REITs, and VICI pays out the yield that is currently sitting at just under 6%. Let's move over to our QuantView stock insight tool to get a broader insight into how VICI is performing. Let's just plug in the stock ticker here and import all of our data. And as we can see here, the revenue has been in a significant uptrend up until this year. This is a recurring trend we can see in the EBITDA and funds from operations as well. But if you look at the AFFO on a per share basis, it has been rather inconsistent due to the share count being diluted heavily. Another appeal to VICI is their great dividend growth. As we can see here, they've increased their dividends every year since their IPO. And if we look at the top of the sheet, we can see that their 5-year growth CAGR has been sitting at almost 11%. Due to their debt position exploding in 2022, their debt to EBITDA has gone up significantly, it now being higher than our desired ratio, but this is something we'll get into a bit more in the next segment of today's video. Also, another thing to note is that institutions have been selling, reducing their overall stake by over 4%. And by the way, if you want to get access to the Stock Insight tool and all of the valuation models that we'll be using in this video, be sure to check out my Patreon link in the description where you can get your hands on a bunch of spreadsheets to enhance your investing journey. And with that out of the way, in today's video, we will be taking a 3-step approach to thoroughly evaluate VICI and determine its fair value. Step 1. Margin of safety. In this step, we'll assess VICI's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into VICI's financial statement and assess critical metrics and ratios. In step 3, we will be using a combination of valuation techniques such as funds from operations and discounted dividend model to get an insight into the value of the business. This step allows us to understand whether the stock is currently overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of VICI Properties as an investment opportunity. To determine this final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. And we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from our margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. As you can see, the EBIT has gone up over the years, going from over $500 million in 2018 to over $1 billion in 2022. The average EBIT growth during this period has been sitting at 21%, which is in the bright green part of a scale, indicating a 10% deduction in the margin of safety. If we then look at the margin, it has actually gone down over the years, going from 62% in 2018 to 43% in 2022. The average margin decline during this period has been sitting at 6%, which is way in the red part of our scale, indicating a 5% increase in the margin of safety in this metric. The next 2 metrics that we'll be looking at are the dividend growth and debt to EBITDA. The dividends have gone up over the years, going from $1.16 a share in 2019 to $1.56 a share in 2023. The average dividend growth during this period has been sitting at 8%, which is in the light green part of a scale, indicating a 5% deduction in the margin of safety. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For VICI, this is sitting at almost 8 years, in this case a 791% debt to EBITDA ratio, which is way in the red part of a scale, indicating another 5% increase in the margin of safety. And the final 2 metrics that we'll be looking at are the occupancy rate and rent reversion. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. As we can see in the top left, all of the properties of VICI are currently occupied, meaning that no properties are vacant and not generating any rent. This is a 5% deduction in margin of safety since, well, all of their properties are occupied, which is a very good sign for VICI. The rent reversion rate refers to the potential for rental rates to change when leases are renewed or new tenants are acquired for a property. As we can see, the gross property has gone up for VICI, as well as the rental revenue, but the margin has gone down slightly. This gives them a negative rent reversion rate of negative 1.5%, which is in the orange part of our scale, meaning no change in the margin of safety on this metric. Looking pretty good so far for VICI, but let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the price to FFO mean reversion. Price to FFO, or funds from operations mean reversion, is a valuation model used to assess the attractiveness of a REIT stock price based on its historical FFO multiples. FFO is a key metric for REITs as it represents the cash flow generated from their core operations. In this model, we compare the current price to FFO ratio to its historical average. If the current ratio deviates significantly from the historical mean, it suggests that the stock may be undervalued or overvalued and is expected to revert to its mean over time. In this case, we've imported the FFO per share and the share price of VICI going from 2018 to 2022. The average price to FFO during this period has been sitting at 18.21, and doing the same with the trailing 12-month data, we get a price to FFO of only 13.14. And this deviation gives us an intrinsic value currently of $40.05, which is an upside of over 38%. The second model that we'll be using is the dividend discount model. The dividend discount model is a valuation method that calculates the present value of expected future dividends to determine the fair value of a stock. It assumes that the intrinsic value of the REIT is the sum of all its expected future dividend payments, discounted back to the present using a discount rate that reflects the risk associated with the investment. The model is based on the premise that investors value the income generated by REIT's dividends, and that future dividends are a crucial factor in determining the stock's worth. We've imported the dividend payments of VICI going from 2018 to 2022, and their average growth rate in their dividends during this period has been sitting at 8%. Or almost 8%, and I'm projecting all of their future dividends to grow by 6%, and we'll be using a discount rate of 10% in this valuation, giving us an intrinsic value of $41.34, which is an upside of over 43% from the current price. And the last model that we'll be using are the AFFO multiples. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for capital expenditures and other non-recurring items necessary to maintain property portfolio. AFFO is considered a more accurate representation of cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to FFO, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers. In this case, I've imported two of similar companies to VICI Properties and their price to AFFO. And this gives us an average price to AFFO in the industry of 10.30, while the price to AFFO of VICI Properties is currently sitting at 14.10, which is significantly higher. This gives us a price per share of this model of $21.11, which is a downside of almost 27%. Let's go look at the final overview of our valuation next. Coming to our final overview, we've imported the price to FFO, discounted dividend and AFFO multiples price per share, giving us an average of $34.17. If we apply our margin of safety that we have determined earlier by using our standard margin of safety of 25%, deducting it by 10% for the EBIT growth, deducting by 5% for the dividend growth and the occupancy rate, and adding 5% for the margin growth and debt to EBITDA, that leaves us with a margin of safety of 15%, and applying this margin of safety, we get a fair value of $29.71. With the current price of $28.90, it implies that we have almost a 3% upside per our valuation, indicating that's a slight buy currently. Now, if you want to get access to all of the valuation models that I use in this video and all of my other videos, and get access to my new model that I've built to gain more insight into stocks, you can check in the description for my Patreon link. This would help me out significantly. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments as well. And thanks for watching.